Hi, welcome everyone. Welcome to episode 6 of this Learn on the Go series. Now, music is something that has been there for many centuries as a hobby, as a profession, and also as an industry. And that is going to be the topic of today's discussion. Now, I know it's not unfamiliar territory for all of us. We all listen to music, hundreds of songs probably every week. And my real interest in this business came in when I was looking through the financials of Tips Music. I mean, what was a profit of 3 crores for a number of years has now been growing steadily from 11 to 43, 65, and it's now gone up to 168 crores. It's the same thing that we see with one of Tips Music competitors, Saregama, and look at this. 6, 7, 9, 28, 54, 113, 150, and it's now at about 200 odd crores. For this video, I'd like to stick with Tips Music as we understand their business model as an investor board with a focus on exploring if there are any opportunities for us to exploit. This video might be a bit long. I'm sure it's going to be a bit long, but if you don't know anything about this sector, then I'm sure you'll find it very useful. Please do note this is purely an educational exercise. Do not consider any of this as a recommendation. I strongly urge you to read this disclaimer. Further, I have not received any compensation from the company to make this video. I'm now a SEBI registered RA. I think these declarations are very important. I also do not hold any shares in Tips Music Limited as of today. And if I were to buy any, it would be at least 5 days post the publication of this video, which is required as per SEBI rules and regulations. Okay, so on a macro basis, there has been a monumental shift in how we consume our music. So what was entirely physical in the year 2000, cassettes, CDs, well, all of it is now digital with over $20 billion in streaming revenues, making up almost 70% of the total recorded music revenues. India is currently the 15th largest music market in the world. It does revenues of around 3,200 crores and is expected to grow at 15% per annum. Now, at the heart of this revolution is the growing influence of online music streaming platforms. Platforms like Spotify, Apple Music, YouTube, Gaana, Saavn, these are all popular names with some of these guys offering free streaming services while others are behind a paywall. Now, as a business, music streaming is extremely competitive and a low margin business. In the previous slide, I had mentioned Wink Music. It's an Airtel product, and that has now shut down, and so has Hangama Music, which shut down, I think, just a couple of months back. Believe me, it's not lack of demand. In fact, in 2023, on-demand music streams in India crossed over a trillion plays. That's trillion with a T, making India the world's second largest market by volume. However, the monetization of this booming consumption is proving to be quite a bit of a challenge. That said, things are improving, firstly on account of digital marketing. That is, a larger part of advertising spends now go towards digital media as compared to print and television. And secondly, the proportions of the number of Indians who are paying for music content, Spotify, YouTube Music, etc. Well, that number is on the rise and is expected to reach 3.5 to 4 crore subscribers over the next 5 years. Both these points are important, digital advertising and the subscription part. We'll try to join the dots together as we look into the inner workings of the company. To simplify our understanding, we'll be looking at three things mainly. Number one, how does the company Tips Music actually make revenue? That's important to understand. Secondly, the moat, which is the music that it produces. Again, that will give us a nice understanding of how strong the company is. And thirdly, we look at the financials, and hopefully that helps us understand what the future prospects of the company are. So that said, let's start with a quick overview. Okay, so Tips Music is one of India's leading music labels. It was founded in 1988 by Kumar and Ramesh Torani. The company's catalog consists of over 31,000 songs across different genres and languages. One can find their music across leading platforms and even on YouTube, with all their channels totaling to over 125 million subscribers. Let's look at the business model, and a very simple way of understanding the workings of a music company is to examine it like any other company. That is, there's a producer of goods and services, there's a distributor, and of course, there's someone who needs to consume those products and services. So in our case, the producer is very simple. It's Tips Music Limited. Now, in terms of distribution, there are a series of companies that utilize the music that's created by Tips in different ways. For example, there's music licensing, wherein someone like a TV network buys the rights for a song for a fixed fee and for a fixed period of time. Publishing revenue is more like royalties that Tips Music would make when their song is played over the radio or in a commercial, etc. Live performances, it's a category that's growing well, but Tips isn't aggressively into it. But the channel that should maximize interest for us is this one, digital licensing, which accounts for anywhere from 70 to 75% of the company's revenue. Now, I've gone through the last 5-6 earnings call, and digital revenue is what the management and the analysts seem to be talking about. So it's basically the karta dharta of the business. So hum bhi yahi karenge, and this single slide will be very useful in helping us understand this part. Let's start from the left, YouTube and YouTube Music. So essentially, Tips is the publisher, so someone like me, and as we all know, there are two kinds of subscribers on YouTube. There's a big proportion of users who watch videos for free on YouTube, but then they also have to watch some advertisements as well. This is obviously the bulk of the people. And then there are a few people who take up YouTube's premium subscription, so they pay a monthly or annual fee for an ad-free experience. In either cases, YouTube retains 45% of the earnings and the rest is passed on to the publisher, which is Tips Music in this case. And by my reckoning, YouTube contributes about 1/3 to the company's revenue. So YouTube is an important source of revenue for Tips Music. And as long as the views keep on increasing, there is money to be made. So this is essentially like a moat, with the possibility of disruption being quite low, as YouTube is expected to be there for many more years. And from a company's perspective, it offers a lot of stability as far as revenue is concerned. I see it in my own work. So when I'm publishing on YouTube, and let's say there's a month where I don't publish anything, or I publish just one video, as the red stars here are denoting, still I do end up making some money in the process. The second source, and I'll move a little faster now, is YouTube Shorts. Now, from a monetization perspective, Tips Music is currently receiving a lump sum compensation. So it's a fixed amount, and this number is not much, 1.5 crores per year. Per the latest earnings transcript, that is Q1 of FY26, this fixed deal with YouTube for Shorts is expected to last for 1 more year, and post that, the management has indicated that they'll negotiate on a per view or a per stream basis. So one way of looking at this is that both parties, Tips Music and YouTube, they're trying to understand this particular form of content creation, that is the short video format, and how best monetization can work here. YouTube is already experimenting. Some of you might be aware that they've now moved the length of the short videos from 60 seconds to 3 minutes, which obviously opens more opportunities for them to make advertising revenue from it. The Tips management is looking at this as a massive opportunity, as high as 25% of revenue from the current 7-8%. So there's a lot of upside that they see, which is also why they're keen to move from a fixed model to an ad-supported one. And the third and final source of digital revenue is the distribution partnership that Tips Music has with a couple of international music companies, namely the Warner Music Group and Sony Music Publications. The objective of these agreements is simple. Firstly, it's to enhance the global reach of the company's catalog, those 31,000 songs. And secondly, of course, to improve the monetization opportunities. So essentially, these partnerships, they'll handle the commercial and distribution responsibilities for all of Tips content across all audio streaming apps globally, so Apple, Spotify, Amazon, etc., except, of course, YouTube, which Tips is directly dealing with. Now, from a financial standpoint, the deal with the Warner Music Group, well, firstly, it's a 4-year agreement and it also involves a minimum guarantee. In terms of revenue, when one of the analysts pressed the management for it, they did indicate that the Warner deal is between 25 to 30% of the revenues in quarter one of FY26, which I think is a pretty good number. The other deal with Sony Music Publishing is slightly different in the sense that SMP would provide a range of services to Tips, such as marketing, licensing, royalty collection, etc., against which SMP receives a commission. For Tips, the benefits include better oversight on content usage, more monetization, and of course, higher royalty collection. All right, so whatever I've covered in the video so far is on how revenues are coming in. You can also think of it as the company's sales engines. And as investors, it's our job to understand how good these sales engines are, in the sense that are these sustainable? Will the company continue to make money out of them? Can they grow even further in the future? So these are the typical questions that each of us would have. I'll delve more on this a little later in the video. Okay, now let's move on to the second variable in our understanding of Tips Music's operating model, which is content. I do hope you remember this image. The first variable is the distribution and the second is the content. Now, Tips Music Catalog is a significant moat. As one of India's largest music labels, it has a strong repository of songs, almost 30,000 songs from the 1990s until today. This is the main driver for the company and is about 85% of the revenue generated. In fact, someone had asked Mr. Torani this question on what constitutes new and old content, to which his definition was any songs that are produced or acquired after the year 2020 is new content for Tips Music, while the rest of it is old, and it's the old one that's currently delivering around 85% of all revenue. Actually, this slide is very interesting because see what Mr. Torani says. I'm assuring you that these songs have a shelf life of at least 25 more years, and over the next 10 to 12 years, all the hit songs will be remade, giving them another life. So you can be rest assured that we will do well. Okay, so this is interesting. Let me show you what this means. Let's go to the Tips YouTube channel and let me type in something. Okay, how about Coolie number 1? I'm sure the younger generation, my generation, would remember movies like this. I'm sure there's a David Dhawan movie. And yeah, see this. This song, Husn Hai Suhana. I don't want to sing this, but it was there in this movie. This is the original movie. I think it's a 1990s movie, 1995, 96 or something. And one of the songs there was Husn Hai Suhana. But that has now been recreated in a new version of Coolie number 1, which has Varun Dhawan, Sara Ali Khan. And this one has 25 crore views. So that's what I think the chairman means when he says that recreating all the hit songs or maybe even hit music, hit movies actually builds in a new lease of life for these compositions which are there. Let's see if there's anything more. Yeah, look at this one. Tujhko mirchi lagi. Okay, so that's the song, and there is a new version of it that's there in this Coolie number 1, and that has got 14 crore views. So essentially, the chairman is saying a couple of things. Number one, Tips Music has songs that have done well in the past, in the 1990s and 2000s. So there is an opportunity of recreating them and making more money from it. And secondly, because it's 31,000 songs, there is all the more opportunity for them to do this repeatedly, and this would ensure revenues for many more years. So that's definitely a plus point when it comes to the business model. There are these assets which are there, and it's more a question of how much you can sweat it out. So that's important. But another follow-up question that comes in here is, what is Tips Music doing in terms of creating or acquiring new content? Presently, Tips Music is quite clear that content acquisition is the key to future growth in the sense that from whatever revenue that the company generates, around 25 to 30% of it is going into new content generation. I even map these percentages on a quarterly basis, and you can see how erratic it is. 35%, then 23%, 8%, 23, 38, 17, 17, again 38, then back to 27, etc. Now, the management justifies this by saying that they are more keen on quality over quantity, and they are okay to having a few songs in the catalog but would want to opt for better quality. This does seem to be the case with the number of songs reducing over time while the content cost is going up. Of course, some of it can be attributed to inflation as well. The product mix is also important. Hindi songs will be more expensive as compared to, let's say, Bhojpuri songs. Similarly, film music is more expensive as compared to non-film music. So there's probably a science behind it that Tips Music understands as to what constitutes a better quality, and that's what it is currently focusing on. As to where this content creation is done, the team at Tips relies on a few avenues. Firstly, there's self production. So, new songs from upcoming artists and the remix or the newer version of the 1990 songs are a part of this. Secondly, the company acquires from others. And lastly, there's always Tips Films, which is from the same promoter group. And whatever 2, 3 movies are being produced by the film division, obviously the music rights are bought by their music arm, which is Tips Music. Okay, I hope this gives you a better idea on the company's content acquisition slash creation strategy. I believe this, along with the distribution of songs, it forms a core part of the company's business model. And the more quality songs that the company can produce, the more distribution avenues that it can generate for itself in terms of reaching Indian as well as global audiences, the more sales and the more profits the company can generate for itself and for its shareholders. Okay, now let's look at the financials. And I think for Tips, the story really starts from the year 2020 onwards when the sales really started to grow up. So actually from FY21, and you can see a build up in sales. So 50%, 37%, 29%, 28%. So there's been good solid growth over the last 4 financial years. In terms of expenses, there's hardly anything when it comes to employee expenses. It's 4%. It's consistently been 4%. And the number of employees are just around 100, 105 employees at the moment. Now, Screener doesn't really classify expenses as content cost, which we have seen is somewhere between 23 and 25% for the company, or maximum around 30%. But if you do a summation of the manufacturing cost and other costs, you're probably going to come very close to the 30%. So look at this last few years. So right from FY21 onwards, 11 plus 18, so that's 30%. 17 plus 14, so that's again 31. This one is a bit high, it's about 40% here. This is again 29%, this is again 29%. So I think this is how one has to look at it. So there are essentially just a couple of expense items here, one being the employee expenses, which is about 5%, and around 30%, which is on content, and probably it includes marketing also. So content plus marketing put together is 30%. So this gives us a nice EBITDA margin of 65%. And I think that's what Tips Music is probably going to try and keep for a very long period of time. So, so that's the operating margin. There's almost nothing when it comes to depreciation. There's no debt in the company, so the interest is also at zero. And then there is some other income. This is a number that's increasing, and I'm sure this is primarily on account of the interest rate that the company receives in their bank deposits, etc. Other than that, the company does pay a tax of around 25%. The net profits have been increasing at a pretty healthy clip. And so has the EPS, which has gone up from less than 1 rupee in FY, which one was it? Yeah, FY20, it was just 80 paisa, 79 paisa, and it's now at 13 rupees. I should also mention there's a lot of cash inside the company. Screener might not give you the right picture. So if you go to other assets and you look at cash equivalent, you'll see 41 crores when it comes to March 2025, FY25. But an examination of the annual report will give us a far better idea. So let's do that. Okay, let me take this to page 130, somewhere on that. Um, okay, let me go down and yeah, note number 7. You can see other financial assets, unsecured, consider good. So there are bank deposits with more than 12-month maturity. So that's about 20 crores. So 21 all put together. Let's go further and we can see investments. This is notes 10 of the P&L account. And we have a bunch of mutual fund investments. These are all debt funds where the company has invested in. Some debentures as well. And this put together comes to 95 crores. Then there's cash and cash equivalent. So that's another 41 crores. And then you have notes 15, which is again other financial assets, unsecured, consider good. And there's a good 116 crores here as well. So I think all put together, this comes to around 271 crores, which is quite incredible, when you actually see that the asset base of the company is just 339 crores. So out of the 339 crores, the cash and investment portion is 271 crores. It's quite rare to see companies such as this, and this is probably what you can define as an asset light business. The asset here is extremely light, and the kind of returns that come out of it is humongous because you're looking at profits of some 167 crores, which I'm sure would ensure there's no debt as well, right? Which means your return on capital employed should be pretty high, which is 109%. So look at this business in terms of its strengths, in terms of its future, in terms of what the financials currently say, and then do your evaluation. Okay, in terms of valuations, Tips Music is at a market cap of 7,600 crores. It does 170 odd crores of profits. So let's do a quick calculation. Okay, so 7,667 crores of market cap divided by 169 crores was the PAT. So this gives us a P ratio of 45.36, 45.4, which is already written here, so dumb of me. So if you examine the P ratio over longer periods of time, you can see that since July of 2023, so a good 2 years back, it's always been in that 40 to 50 kind of a band, except for this period where there was maybe it was overvaluation, but it's generally been there, right? So I would say that at the current P ratio of 45, Tips Music seems to be fairly valued. I'm not a fan of 45p companies, so probably it's at the upper limit of, or the upper band of the acceptable fair value for this particular company. But another way in which you can look at this is what are the prospects of this company over, let's say, the next 5 years. Okay, now the company has grown by 50%, 38%, 29, 28% over the last 4 years. But let's be a little conservative. Let's assume the company will grow at 20%. The other thing we know is that the current P ratio is 45. I'm going to temper this down as well, assuming that this company or the sector does not deserve 45, probably deserves a 35. So we're going to play around with these numbers. Let's see how this works. Okay, let me open the calculator now. And 169 was our PAT for the previous financial year, FY25. So let's multiply this by 1.2. That's 20% growth raised to the power 5. And what we estimate Tips Music might achieve as PAT in the year 2026 FY30 is 420 crores. So 420, which is your FY30 estimated PAT, multiplied by your estimated P ratio in FY30, which is 35, gives us 14,718 crores as the projected market cap of this company. Where are we right now? We are at 7,667. So again, it's pretty much the same mathematics. So you divide it by 7,667. This comes to 1.91. Okay. So 1.91 raised to the power 1 divided by 5 minus 1 gives us 13.8%. So I know there are lots of ifs, buts, and assumptions here, but assuming the Tips Music continues to grow at 20% over the next 5 years, and the business, the sector, given the fact that there is no debt here and there's a lot of tailwind there is a nice disruption that's happening, and the company has a nice repository of songs which is likely to last for the next 20-25 years as per its own estimates. So let's say the company does end up receiving a P ratio of 35, then from a stock price perspective, it's a increment, or it's a compounded annual growth of 13.8% over the next 5 years. So it's just simple mathematics. I'm just trying to put a perspective there, just for you to understand that how things might work. But as I said, there are lots of ifs and buts here. What this also explains us is that things are never going to be linear when it comes to understanding any business. This is completely linear, what I've done, assuming that it's just going to go like that, but that's never the case. And let me explain this from a Tips Music perspective. So in Q1, even Q2 of FY25, the management, Mr. Tarani, was confident of growing sales by 30%, as you can see here. And they did come very close. I mean, Tips Music didn't do 30%, but they achieved a sales growth of 28.6%, which is almost there. Now, in Q3 as well, which is the same year, FY25, Mr. Tarani projected the same 30% growth for the following year, that is FY26, which is this financial year. But notice how the tune has changed in FY26 in the earnings call that was held on the 30th of July this year, where Mr. Tarani displayed a lot less confidence on achieving 30%, and he seems to have settled more on 20%. Obviously, there are a few reasons for this dilution in confidence. The first is sort of a mini disruption that's happening with audio streaming platforms, with many of them moving from free consumption to paid subscriptions. This was expected, and we've been seeing this with YouTube, Spotify. All of them are becoming a bit restrictive, thereby motivating users to migrate towards a paid subscription. A second reason why growth targets are a bit subdued is the closure of some audio streaming platforms. So a year back in 2024, Resso had shut shop. And then in December, we saw Airtel's Wink Music closing down as well. And most recently in April of this year, Hungama Music also decided to cease operations. Obviously, this would have led to some tempering of growth for music companies, but if you are, let's say, a music lover, and if one of your favorite platforms were to shut down, then obviously you're going to find some other platform that you can consume your favorite music from. So I think this is more of a temporary phase, but something that one should still take into account. The third reason, which will also have a small impact, is any increase in subscription fees. And very recently, Spotify hiked subscription fees by 20% on average, which might lead to some disruption. Another factor, and a rather big one, is a slowdown in growth on the YouTube platform. Now, as we learned earlier, YouTube is a big revenue contributor, and while the management had previously estimated a 25 to 30% growth, the revised numbers now say 15 to 18%. This revision is on account of two factors. Firstly, views on YouTube Shorts were lower than normal. Now, it's possible this is just cyclicity at play, but it's still something one should look out for. And secondly, YouTube has implemented some new policies aimed at reducing music piracy. While the objective of this is good and positive for Tips Music over the long run, the immediate implementation of these restrictions is likely to have some performance fluctuations. So it kind of all adds up to the uncertainty around any business. And this is why Tips Music and Mr. Parani are more comfortable guiding for 20% rather than 30. One can also look at these infractions as risk factors. So there are some distribution related risks like platforms changing their business model, or what if a platform becomes so big that they start dictating terms to the music company. So that's a risk. Of course, risks can also be there from the content side as well, as in consumer preferences can always change. What if people no longer enjoy music of the 1990s? And another content risk is music being composed and sung by artificial intelligence. So even that can happen. But that said, I'm kind of summarizing it here. But as a sector, music is definitely evergreen and is expected to grow at 20 to 23% per various reports. As a creator of music, Tips is in a better position than platforms, at least that's what I think, with a resilient catalog of over 30,000 songs, which is expected to sustain growth for the next 20-25 years. This gives them an edge. The company continues to invest in quality new content. Internally, the break even for the content that they've acquired is actually 3 years, although they tend to say 5. Formats like short form content on YouTube, Instagram, and TikTok are emerging opportunities, and their monetization can be a huge boom for the business. And finally, more and more Indians are accepting paid subscriptions as a way of life. I count myself in this list: Swiggy, Hotstar, Sony Live. I think I have like 10, 12 subscriptions, which augurs well for the music industry as well. In summary, I'll say music is something that investors should be watchful of more as a trend. Indian music is amazing. We all listen to music, and for me, it's very difficult to comprehend a situation where music as a sector will not double in terms of revenue and profits over the next 5 years. It can even triple over the next 7 years. That's the phase at which we see the music industry at the moment. That said, there will definitely be some disruptions and changes in the business model. AI might come in, platforms might get shut down. There'll be an even bigger movement towards paid subscriptions, or the operating model of these platforms might change completely. Consumer preferences might change, etc. It's all a part and parcel of how to do business in the 21st century. But as far as the fundamentals are concerned, I really don't think it's flawed. In the sense that there is enough scope in music companies to do well over the long run, and who knows, Tips, Saregama, T Series, all these guys can take a massive advantage of this tailwind and probably do a lot of good for their shareholders. This is just my opinion. Again, this is not a recommendation. And if you have a different point of view, or if you agree, disagree with any parts of what I've said, please do let me know in the comment section below. I would, I kind of tend to read each and every comment that comes in, and I answer most of those. So would love to know what your perspective is. And yeah, that's it for today. This was a very, very, very long video, but I hope you found some parts of it useful, and I'll see you very soon with another video.